Capital A is probably the only app that lets you control how taxes are calculated or estimated within the application. It doesn't matter where you are in the world, you can define how taxes are calculated by creating a tax preset, selecting an existing one if you have it, or importing one that somebody else prepared. First, select the country you need, then choose a currency and the currency offset if required. If you select D1, it means that the currency exchange rate from the previous date will be used. Next, create the rules by adding statements. To add statements, click Add First Statement. You can use the predefined statements or the snippets provided below. For example, if you need to calculate taxes on stock sales income, you can use the corresponding snippet, which will add the necessary statements for you. The most basic statement is if, which checks the currently evaluated transaction and executes the statements within the block if the condition matches. In this snippet, we check if the tax type is sales tax. The tax type mostly depends on the transaction type, so you can choose from buy, sell, dividend, interest, rental, and other. The capital tax is a special case which we will cover later. Next, we select a tax group. A tax group is a way to accumulate taxes, revenue, and expenses in a single place in the taxes report. If you have stock sales, you can accumulate the taxes from them in a single tax group, while dividends can be accumulated in a separate group. Tax groups are global, so two different tax presets can use the same tax group as long as the country, currency, and offset are the same between them. Here, we check the asset type to apply a specific tax rate. If you have a different tax rate for crypto, you can add a separate if block for that by deselecting crypto from the asset type condition. By hovering your mouse between the statements, you will see gray and blue lines. Clicking on a gray one adds an if block, while clicking on a blue one adds a new statement. In this case, we want to add an else if block for crypto assets with a different tax rate. The tax rate is applied to transaction income, which is the current revenue minus expense. You can select different tax rates for different conditions. In some cases, the tax rate may depend on the age of the position. There is a separate snippet for that called position duration. You can add it directly within the if block. Here, if the tax type is sales tax, the asset type is stock or ETF, and the duration in days is lower than 60, we will add a note and apply a specific tax rate. Notes are optional, but helpful for providing information that will show up in the taxes report. They can be used to add context for yourself or your tax accountant as they will be exported in the CSV. After adding a note, you can select the appropriate tax rate. If the position duration is longer than 60 days, the else block is evaluated here, and you can add another note and apply a different tax rate. Once a tax is applied, no further statements will be evaluated for that particular transaction, so you can remove any redundant apply tax statements. Using this menu, you can copy, cut, duplicate, or delete statements. To move statements around, simply cut and paste them in the desired location, the same as you would insert a new statement. Another common scenario is the tax on fixed income. You can use a snippet or create it from scratch. The snippet allows you to differentiate tax rates based on the domicile. First, we check if the tax type is dividend tax, then check the asset country, like United States. You can check this to be the asset country, account country, or market country. Next, we select the tax group, such as dividends/US. The slash allows you to nest groups within each other, so the numbers are accumulated on all of them. In this example, we have two levels, dividends and the dividends country. If you only need separate tax group but have a single tax rate instead of repeating yourself, you can set the tax group within the if blocks and apply the tax directly below it. In some parts of the world, a wealth tax is required, which means you are taxed on what you have, not necessarily on the income you have generated. There is a preset for that called capital tax on value. This works by scheduling a capital tax event yearly on the last day of the year, and it is configurable. All statements within a rule will be evaluated as usual with the tax type set to capital tax, along with all statements within the schedule block itself. Here, we check if the asset type is real estate. But for more complex conditions, you can use and or blocks. Just select wrap in and/or on an existing condition, and you can match multiple criteria, such as the asset type being real estate and the asset country not being your home country, for example. When taxing the market value, you need to change some properties. First, set the revenue to the current market value, because as these are open positions, the revenue will be zero as you haven't sold them yet. Second, set the expense to zero, because by default, the expense will be the amount you've paid for the asset. If you are allowed to subtract ongoing fees from the market value, you can set the expenses to fees through this menu. Wealth tax is often applied progressively. To do this, use Apply Progressive Tax, which lets you define the lower bound of income from which a particular tax rate will be used. The income is accumulated from different capital tax events on the same tax group. In this example, once your income minus fees accumulates above 1 million, a specific tax rate will be applied. You can add more brackets or have the first one starting from zero. And that's about it. If you have any questions, please let us know at support@mycapitally.com. Thanks for listening.